Welcome back to the Neuro Finance Masterclass. I'm host A, and along with host B, we're diving into day 57 of our 365 Days to Financial Freedom series. Look, we really need to have a deeply serious, grounding conversation today. We've spent previous explainers methodically exposing the whales, the short sellers, the supercomputers. We've built a rock-solid foundation. But right now, we're stepping into the absolute most dangerous arena out there. Today, we are taking on the final boss of the retail casino, options trading. And our theme for this session is options trading, insurance versus gambling.
Exactly. And as we settle back in, let's just get one thing crystal clear right out of the gate. We are not here to sell you some pipe dream. We aren't here to entertain fantasies of getting rich overnight. We're here to protect your capital and build that architect mindset. And to do that, we have to look really, really closely at the tools that are specifically designed to separate you from your money. So let's get into Section 1, the ultimate retail casino. We need to aggressively pivot to the core problem we're seeing literally everywhere right now, and the bait they use, it's this mythical, almost magical number, 1,000%. You see it all the time, right? Flashy influencers constantly bragging about making 1,000% returns, practically overnight, using quote-unquote options. And honestly, it's incredibly seductive. If you're a novice trader just trying to escape the rat race, and you see someone turn $1,000 into 10,000 in 24 hours, man, that triggers every greedy impulse in the human brain. It's almost comical how many people treat the stock market like some blurry weekend trip to Vegas. Except, in Vegas, you at least get a free drink while you're losing your shirt. Right, but here is the stark, truly terrifying reality that totally crushes that fantasy. 99%. What those flashy videos conveniently leave out is the 99% of people who tried to chase those exact same mythical returns and literally lost their entire life savings the very next day. They don't post screenshots of their accounts plummeting to zero, do they? They aren't making TikToks about having to sit their family down and tell them they gambled away the down payment for a house. The hype online is incredibly loud, but the destruction is silent, and it is absolute. Which brings us to Section 2, defining calls and puts. Now, before we completely reject this tool, we have to clinically understand it. We don't operate on fear here. We operate on knowledge. So what actually is an option? Well, it's exactly what it sounds like. It's a legal contract giving you the option, meaning you have the right, but crucially, not the obligation, to buy or sell a stock at a specific price by a specific date. First up, we have the call option. When you buy a call, you're essentially making a highly leveraged bet that a specific stock is going to go up. But here's the catch. You are not actually buying a piece of the company. You aren't taking ownership of an underlying productive asset. You are merely buying a speculative piece of paper that hopes the price increases by a certain time. Exactly. And the flip side of that coin is the put option. This is a legal contract giving you the right, but not the obligation, to sell a stock at a specific price by a specific date. In plain English, it's just a bet that the stock is going to go down. It's the exact same speculative paper as the call option. You're just betting in the opposite direction. But whether you're playing calls or puts, the fundamental truth remains exactly the same. You are keeping yourself trapped inside the casino. You're placing directional bets instead of actually owning a piece of the global economy. Let's move to Section 3, the ticking time bomb. This right here brings us to a mathematical nightmare known as theta decay. Think about it like this. When you buy a normal share of stock, let's say an S&P 500 index fund, you own it forever. You literally have infinite time. If the market crashes tomorrow, you don't lose your shares. You just wait maybe 5 years for the market to recover. Time is your greatest ally. But an option, it has an expiration date. It is quite literally a ticking time bomb. Let's say you bet a stock will go up by this Friday. If it doesn't move, or even if it moves too late, at exactly 4 p.m. on Friday, your contract mathematically drops to exactly zero. All that value, it just evaporates into thin air. Time, which is normally the investor's best friend, is the option trader's absolute worst enemy. I really need to hammer this terrifying reality home for a second. You don't just have to be right about the direction of the market, you have to be perfectly right about the exact timing. Do you realize how incredibly difficult that is? Predicting market direction is already hard enough, but predicting exactly when a stock will move before expiration day, it's practically impossible to do consistently. Because if you're right about the stock going up, but it happens on Monday instead of Friday, well, you still lose everything. Your money goes mathematically to zero. And that leads perfectly into Section 4, insurance versus gambling. So, a perfectly logical question arises here. If this tool is practically guaranteed to wipe out retail investors, why on earth does it even exist? Well, it comes down to a stark dichotomy. Wall Street professionals actually use options for hedging, which, by the way, is just a fancy word for financial insurance to protect their wealth. Meanwhile, the retail amateur is using these exact same contracts as lottery tickets, literally gambling their rent money. The tool itself is exactly the same, but the application, it couldn't be more different. Let's actually look at how this plays out in the real world. Imagine a billionaire who owns $100 million in Apple stock. To protect that massive exposure, they go out and buy a few put options as insurance. So, if the overall stock market crashes, sure, their Apple stock position loses value, but those put options, they skyrocket in value and make a massive profit, completely balancing out the loss on their stock. They successfully protected their wealth. Conversely, you have the amateur. They take their hard-earned rent money and buy highly speculative call options, just hoping to get rich quick. In that exact same market crash, their capital drops straight to zero. Complete loss of funds. The professional uses the casino to buy insurance, the amateur uses it to gamble. Let's wrap this up with Section 5, the architect's stance. I am issuing you a strict cognitive mandate right now. You absolutely must fundamentally recognize the profound psychological and mathematical difference between being an owner and being a gambler. True architects, they build empires by accumulating productive assets, stocks, real estate, Bitcoin, and they hold them through the decades. We harness the immense power of infinite time. We strictly, categorically refuse to play with ticking time bombs that can evaporate our hard-earned capital at 4 p.m. on a Friday. So here is your actionable homework for today. Protect your capital and protect your neuro fitness right now. Step 1, open your brokerage app on your phone. Step 2, go into your account settings and find the options trading permission. Step 3, permanently disable it. Literally lock the door to the casino. Do not give yourself the temptation to play these insanely dangerous games. Leave the options trading to the Wall Street professionals buying insurance and let the online gamblers play their wealth-destroying games without you. As we close out, ask yourself honestly, are you building an empire or are you playing with a time bomb? Are you patiently acquiring productive assets that are actually going to care for your family for generations, or are you chasing 1,000% screenshots while risking a 99% chance of absolute ruin? The choice is entirely yours, but trust me, the math is unforgiving. Choose to be an architect. Thank you so much for joining us for Day 57, and we will see you in the next masterclass.